There's gold in them there hills. You've been told that a 60-40 portfolio is good enough, but 50 years of data says there's a better mix, and it includes gold. The optimal portfolio wasn't 60-40. It was 18% gold, 49% stocks, and 33% bonds. Today, I'll show you why that works and how to use it. We've been showing clients how to use gold since the very beginning. We started this company in 2000. I grew up with my dad selling gold. He bought a gold business in 1988 and began selling gold to high net worth individuals. So I've seen people buy and own gold for a very long time. And we were using it in our clients' portfolio before it was popular. And now, of course, with the last 3 years, gold averaging about 22% per year, all of a sudden it becomes very, very popular. But if you remember that old Barbara Mandrell song from the early 80s that was called I Was Country Before Country Was Cool, I was doing gold in my clients' portfolios way before it was cool. And we really were able to launch it even more when the ETF GLD came out in 2003. And of course, the rest is history, with gold outperforming stocks in the 21st century. In the next few minutes, you'll learn the simple portfolio mix that outperformed on a risk-adjusted basis, why gold shines in crises and calm markets, and I'm going to show you a step-by-step plan to add gold the smart way starting now. My name is Tommy Cloud. I run a wealth management firm and have done so since 2000. I have clients all across the country and advise people and consult people on their investment portfolios as well as other areas in their financial life since 2000. Let's start with the fact. Researchers studied 5 major asset classes from 1973. Now, keep in mind, the dollar came off the gold standard in about 1970, so our first information for gold really should start about January 1st of 1971 is when we should be looking at the spot price of gold for long-term performance. But this study goes from 1973 to 2024, after the U.S. left the gold standard. They tested portfolios across bull markets, bear markets, inflation, and deflation, as we saw in 2008. They're finding portfolios with 1 to 35% gold had better risk-adjusted returns than traditional balanced portfolios. And the sweet spot, it was about 18% gold, 49% global stocks, and 33% global bonds. Why does this work? Diversification. As King Solomon said, he was only given one thing to ask God for. He asked for wisdom. And he said in his writings, diversify your wealth 7 or 8 ways because you do not know what danger may fall upon the earth. King Solomon, in today's dollars, would have a net worth of about $2.1 trillion. He would literally have about a 10 times net worth over some of the most popular and wealthiest men on earth today. So gold moves differently than other assets. Its correlation with stocks is about 0.01, which means it's near zero. And its correlation with bonds is 0.08. So it's not correlated to stocks or bonds, which to me is equally as beautiful as the long-term returns. I mean, you could say cash isn't correlated, but cash loses money to inflation. So this means, what does this mean when I say there's no correlation? Okay, well, when stocks or bonds are stressed, gold often does its own thing. The result, a smoother ride without giving up long-term strength. I'm telling you, for the long-term performance of your portfolio, the number one thing that you want to do is prevent those big, enormous drops. It's caused the stock market to be break even for long periods of time, like from 1920 to 1954. Or from 1966 to 1982, or from 2000 to 2013. Those are long periods of time that if you don't have diversification, you will have to experience those. However, if you have diversification with a great asset class like gold, then it greatly diminishes the time that it takes for you to get back to break even. I mean, it's absolutely dramatic. So why gold wins when it matters? Here's why. Let's talk about resilience. When do you need protection? During a crisis. Across 8 major crisis scenarios like equity bear markets, high inflation, and periods of high economic uncertainty, gold was the best performing asset in 7 of the 8. That's pretty awesome. The time when you need the most emotional support, when you're looking at the money that's been entrusted to your care, when you're seeing those statements, Gold has come to the rescue 7 out of 8 times since 1973. That's pretty powerful. That's got to make you happy. That's got to make you curious. That's got to make you believe God's word. Okay, I won't go that far. That's what it does for me, but that's a whole different topic. Even better, across all economic regimes, there's normal growth, ideal conditions, stagflation, and deflation. This is consistent with what the wealthiest man that has ever lived was trying to teach. Gold consistently ranked in the top 3 asset classes during all economic regimes, the good times and the bad times, in other words. Gold doesn't just help in end-of-the-world moments. It helps across all the cycles. So how to use gold in your portfolio? Here's a simple plan. Number 1, you want to pick your vehicle. Now, for most people, that's going to be a low-cost gold ETF. It's the easiest way to get exposure. And some of the ETFs, like Ounce, makes it where you can take physical possession if you'd like to. And its operating expense is 0.25%. If you want to go with the most popular one, is GLD, and its operating expense is 0.4% a year. So that's extraordinarily reasonable. Now, if you prefer physical gold, understand storage and insurance, keep it simple and secure, I recommend you buy bullion or large 1-ounce coins, which have now gotten quite expensive. Some will look at mining stocks, but remember, these mining stocks are extraordinarily volatile. I mean, you think technology stocks are volatile? Put your money in some gold mining stocks. It's worse. It's more volatile. It's one of the most volatile common stocks, sectors, or industries that you can buy into, for sure. Now, there's some like really small ones where you can buy into really interesting ones, but like when you get into ones that have large markets, the gold miners are extremely volatile. I don't recommend that. I just don't see that. We don't use that in our clients' portfolio. We never have. A good ETF for gold mining stocks would be ticker symbol GDX. Now, what you want to do is you want to choose your target. And I would aim for a strategic range of 10 to 20% or even more. It's not uncommon at all for our clients' portfolios to have a minimum of 20%. That would mean there'd be 5 other asset classes in there that we had with it. And sometimes we'll even do more. If we want to do, like a third, we're not at all shy about putting our money in gold. It's been around for the entire history of the earth. And according to the Bible, it's going to be around for all of eternity on the streets of New Jerusalem. So gold, God has talked about it and assigns it value. And therefore, I believe that it's going to continue to have value, just like it has for just about every single moment that the earth existed. It probably wasn't there in the very beginning, but was discovered shortly thereafter. The research suggests that 18% was optimal in testing, with 49% stocks and 33% bonds. If that's what you want to go, this is definitely not one size fits all. So keep that in mind. If you're starting from zero, you want to ramp up in steps. For example, maybe 5% this month, and then maybe 5% next quarter, and you can start kind of growing like that. You want to set your rules. Rebalance twice a year. When your goal percentage drifts 3 to 5% from target, don't guess short-term moves. Let your rules do the work. So when you're reviewing it with your financial advisor or yourself, you probably want to do it, at least annually, and take a look at what's happened to gold in comparison to the rest of your portfolio, and just make the adjustments real quickly. And here's some common mistakes that you want to avoid. Don't go all in on gold. Don't go all in on anything. That's just foolish. It's a diversifier, not a magic ticket. Gold is the same way. Gold took a tremendous drop in 1981, and it never really recovered until, I think, 2000. So gold can be underwater too for a long period of time. So gold needs stocks just as much as stocks need gold. And then, of course, there's real estate. We're not talking about that right now, but that's another great asset class. Don't ignore cost and taxes. Use tax advantage accounts when possible. Don't treat headlines as a strategy. That's one of the worst, most unfortunate things that I've seen clients do over the years, is reading these headlines or getting these awesome newsletters that they think so fantastic. And it's really, really hurt my clients. And I hope it will not hurt you. And over the years, my clients have learned to ignore it. It's something that we talk about, but not even most of my clients. But when I say they've been hurt by the headlines, I've seen a few of my clients hurt by those over the years. And it truly has been devastating in some cases. Your edge is steady, rules-based investing. That's what you want to do. So what if gold underperforms for a while, like it did from 1981 to 2000? That's a 19-year time period. That's a lot of patience. And that's okay. The goal isn't to win every month. It's to improve the whole portfolio's risk-adjusted return over time. And let me put that in a simpler way, to avoid the big drops. Those big drops are what affects your portfolio's long-term returns more than anything else. The last thing you want to do is be stuck in one of those scenarios where your portfolio drops 50% or even 25%. It's just not necessary. It's really not. Your portfolio really over a long period of time, depending on what kind of protection you have, there's possibilities and capabilities really where your portfolio shouldn't have to drop over, really 5% over a 5-year time period if you're diversified properly or have the proper investments in place. The research showed that including gold, especially near 18%, improved risk-adjusted returns compared to traditional blends across the 1973 to 2024 time period. So why not just stick with a 60-40 stock portfolio? Great question. Because in many environments, 60-40 didn't diversify enough. That's why. And when I say it didn't diversify enough, it means that the decline was too great. Do you want a larger decline in your portfolio or a smaller one? Well, of course you want a smaller one. Gold's near zero correlation to both bonds and stocks helped reduce portfolio stress when stocks and bonds were struggling. So let's go ahead and real quickly jump here and go look at gold compared to stocks and bonds, and then we'll come right back. I'll share my screen with you. All right, so let's look at it just real briefly. You can see gold has averaged since 1987 about 5.45%. Now, really a more realistic return going back to 1971 is going to be about 7 or 8% per year for gold. But gold's just become extremely popular. We've seen it happen before. If you go down here, you'll see gold is averaging 22% per year over the last 3 years, almost 23%. You can see over the past year, it's up almost 34%. And then you can see over the past 5 years, it's averaged over 10% per year. So gold, obviously with these type of numbers, the herd and other people are going to become extremely interested in it for the wrong reasons. And they're becoming interested in it because it's hot or it's made money recently, instead of being interested in it to help them provide their portfolio with a long-term diversifier that will stabilize their portfolio's returns over time and therefore give them more money over a long period of time in their portfolio. So gold should be first viewed as a diverse, and we never try to time markets. All right, so let's wrap this thing up. And as a reminder, please go ahead and subscribe our videos. I'm trying to get to 500 subscribers by the end of 25. And we love to know that we're providing valuable content to you. The research-backed mix that boosted risk-adjusted returns was 18% gold, 49% stocks, and 33% bonds. Gold's edge is very clear. There's near zero correlation with stocks and bonds, strong crisis performance, and consistent strength across market regimes. Now, by regimes, I just simply mean good times and bad times. So your pick, you want to pick your gold vehicle. You want to set a target in the 10 to 20% range and then rebalance with simple rules. If you want help building a portfolio that's tougher in good times and bad, apply for a free sudden wealth planning session using the link below, or you can take a quick quiz and see how much you need for retirement. And I'll show you how you can fit gold into a plan that matches your goals. We'll see you on the next video.